To have you back with us, Richard. Now, what sort of reaction are we seeing from investors to the situation that's unfolding in the US right now?
Well, I think it's interesting because broad market sentiment continues to remain pretty positive, actually. There is still this element of dollar weakness that is coming through markets, but that is actually part of the positive risk appetite anyway. But the dollar weakness that we've seen could also be playing out as part of the reaction to these riots that are going on in the United States, because having riots across 30 cities is quite a significant event, and it's going to impact on obviously confidence for the consumer, but also retail sales. And it affects how the US economy can start to regenerate itself after this period of lockdown. So there's going to be some downward revisions to some of the expectations to the US economic recovery, and that obviously plays into how the dollar performs. And I think that could be a little bit of a negative bias, but overall not especially all that significant at the moment.
That's right, and we know markets had been rallying on the prospect of the US economy finally reopening after weeks of shutdown, but we're now seeing businesses feeling the need to close down just as they were reopening. So what impact will that have on the economic recovery in the US?
Well, as I said, I think it's more to do with consumer confidence and obviously the retail side, because around 70% of the US economy is based on personal consumption. So that obviously plays into the retail angle and the consumer confidence side. So it's going to be an important phase for the economy, because obviously we've got Donald Trump, who obviously doesn't tend to react especially positively in these sort of situations in trying to diffuse the situation. He's got an election coming up in November, so he's going to be playing to his base, and he's already been sending tweets that suggest that when the looting starts, the shooting starts. So that's really incendiary language, which is not going to help to diffuse this situation, which could continue. And the longer it continues, the more it's going to play into negatively for businesses, negatively for the US economy. As you said, we've got store closures, we've got stores that are not reopening because of this at the moment, because how the US economy gets out of the lockdown could then therefore be phased back. And I think it's an important period for the US economy, and it needs to stop soon, otherwise it could have a significant impact on some confidence levels.
Now, investors have also been keeping a close eye on the rising tensions between the US and China over Hong Kong. Markets were rattled by that last week. Is that likely to take a back seat this week, or are investors still keeping an eye on that?
See, I think this one is just the one that's been put on the back burner for the time being. We had that announcement from Donald Trump on Friday, and actually there was in fact a relief rally slightly on the back of that announcement. But it's interesting that they didn't announce any intentions to put tariffs on China. Now, that is the key issue, because China now is looking at potentially sort of scaling back its purchase of US soybeans, which, if that is the case, then that starts to negatively impact on their agreement for the phase 1 trade deal. So that could then induce a bit of a reaction from Donald Trump, who, as I said, has got an election around the corner, and he could get a bit more hard-lined with China in that response, and that could again bring the trade tariffs dispute back into the fore, and that would be negative for markets. So it could be one that we see play out over the next weeks rather than immediately.
Okay, Richard Perry from Hantec Markets in London, thank you as always for your analysis.